Welcome back to the Automotive Market Minute, in which may or may not take just over a minute. My name is Steven Georgella.
My name is Philip Tripotowski.
And I'm James Subco.
We are revved up here at the Automotive Market Minute, possibly the highest energy pre-brief we've had in our history. Here we go. We'll be talking about national performance. What exactly happened in the month of September? There were some serious highs, but there were some dangerous lows. We'll be unpacking that. The tree map is officially here. Mr. Phil Tripotowski and Mr. James Sivko will be going over the first rendition of the tree map, and we'll be forecasting the special things to come with the tree map, the ugly subprime data, tricolor, or as I've heard, tricolor. Not sure how well I did there. We'll be going over what exactly happened and what type of dangers there might be ahead. Issues in underwriting. What the hell are the banks doing? Mr. James Sivko, our subject matter expert, will be unpacking that. And I will be having a very special rant. What the hell did you expect? If we were going to make the decisions that we made over the last few years, what the hell did we all expect? Stay tuned for that. Let's talk about our national performance. If you enjoyed this video, hit subscribe. It's free, and we want to make more videos that you love for people just like you. Thanks for the support. 103 dealers happy to pass the century mark here at Fountain Forward. What's interesting is when sitting here looking year over year, sales are actually up. It's very important to look at the fact that light trucks and EV sales, and many people could say that the EV sales were pulled forward. Mr. James Sivko used those words a while back when it came down to some of the other vehicles and incentives, etc. So what's interesting is the light trucks and EV sales are what really boosted sales, but passenger cars down 9.7%. So that's what kind of normalized everything. But again, light trucks and EV sales really brought things up. And as I'll talk about more in my rant at the end, the pressures that we're hearing are, we'll hear a dealer reach out to us and be like, man, listen, August was great. September was great. I'm just not making any money. That's the thing that keeps coming up over and over and over is actually year over year, I did just fine, but I'm not making near as much money as I did last year, or I'm not making as much money as I forecasted. During my rant at the end, I'll be unpacking that. You'll see month over month. This is the cool down. This is some of the pain that dealers had mentioned. You'll see the fact that leads were down, traffic is down, appointments are down. But look at those closing percentages. Look at that, what I will call to be apprehension in the consumer when it comes down to actually closing the deal. And by the way, I urge all of you salespeople to remember, the car buying process is lengthened. So let's remember, just because those leads came in, that 4%, 5% discrepancy there, that means there's still plenty of people that are probably going to buy in the month of October. Keep hammering those leads. Go ahead.
We have seen both new and used inventory levels rise in recent weeks. New day supply is currently at 80.8 days, which is 6% below last year's level, about 5 days lower than it was last year, but it is the highest level since late June. If we look at the used inventory side, we can see that used inventory came in at 2.22 million units. It's actually up 7% against 2024. New retail sales have decreased 2% in the most recent week to end September, but still remain 8% higher year over year. New retail sales are still up 5% year to date. However, in the used retail market, we're up 9% against last year and up 4% year to date. Now, you do start to see towards the tail end of September, these start to fall a little bit. So I know it's October. You can see clearly it's spooky season at the market minute. Will spooky season continue throughout October?
Let's not forget what happened to CarMax in the month of September, or realistically, when they came out with their most recent report through Q2. Looks like they had a bunch of vehicles that were a little bit on the higher price side, possibly on the acquisition side, and they got whacked. And they got whacked pretty hard, pretty quickly. If I'm not mistaken, we're looking at a company that was trading in the $90 range, I believe it was. And I believe as of October 8th, we were seeing a current price around $44, give or take. So you see CarMax, and I'm kind of looking at it, I'm going, what exactly is happening? And they're talking about cost cutting. They're talking about cost cutting of $150 million in selling, general administrative, and other things over the next 18 months. So I think it's a very interesting spot for a lot of these used car retailers.
the Automotive Market Minute tree map is officially live. Now, what are you looking at? You are looking at a bunch of boxes. The size of these boxes are determined by the volume of sales for this particular model. The color of these boxes is going to show the year over year change. These are specifically year to date numbers, but how well have these models actually performed year over year? As you start to look at manufacturer by manufacturer, you can see that for most, there are certainly some bright spots, some highlights, certainly worth mentioning. But there are a few manufacturers like Volvo and Tesla, which don't have any green. They are red across the board. They have been all year. And some of these manufacturers are really struggling. Some of them have actually been performing quite well.
Another thing it achieves is all of the box sizes together are put in a larger box, which tells you how big and the market share of each manufacturer, which is great to kind of get that visually. But one of the things that jumps out to me is every single manufacturer has at least some bright spot to talk about, unless you're talking about Honda, Tesla, or Volvo. So even Stellantis has seen a couple of models recover, and their Ram pickup is at least selling even with last year. Maybe one of our big stories of 2026 is going to be Stellantis finally meeting the market and finally acting like a car company again and achieving some unit sales.
If you see some of these boxes that don't have actual characters in them, Phil, if you can highlight one of them, you'll notice that it's really just because it was too small. Each one of those is a model. In the event that you had any questions, our tree map will continue to be improved on a month-over-month basis. And I'd also like to highlight Angie and her incredible team at Fountain Ford on the technology and innovation team, but also going back to the Stellantis thing. And again, I realize I'm probably going to talk in a vacuum here, and maybe I'm just in a little box. The Hemi, baby. Maybe I'm the only one in America that in 2021 saw the Jeep SRT go away, the 392. And it's like, what are we doing? This is America. Let me start the thing up and wake up the neighbors. That's just part of it. I need the Jeep Grand Cherokee to have a Hemi in it. It doesn't even have to be the 392. It needs to have a Hemi in it. I need vehicles to have Hemis in it. I need to be able to roar around. I need a Challenger to have a Hemi in it. I need a Charger to have a Hemi in it. I need a Durango to have a Hemi in it. And finally, it's coming back. And I'm going to make the call right now. I think the American people come roaring in support of the Hemi coming back. I think those sales skyrocket, maybe nothing crazy. I think you'll see a lot of American support for Ram trucks with Hemis in them and also on the Jeep side.
What is a skyrocket in 2025? You're seeing lots of individual models here that are up 20 and 30% versus last year. So when you hit something that the consumer really likes, they will rip it off of your lot. If your manufacturer is able to meet that demand, then you've got something special. The car business has been very good about making models that people want. In 2026, if the designers get it right in a lot of places, we'll have a lot of consumers driving away with the new car.
Hey, and shout out to the Jeep Compass with that 50% increase. Sold 10 last year, sold 15 this year. Let's roll.
Drop a comment. Let us know what you want to see in future episodes. We can dive in. We can break out models by brand. So you let us know and we'll report on it in the future. Looking at financing, we have seen incentives start to pull back a little bit, just at 3-year highs, and not for long. We're seeing them pull back in September. We're seeing them, many manufacturers continue with the same incentives or worsening incentives so far in October. And as the Fed has started to cut rates, what have we seen? We have actually seen average auto loan rates start to creep higher throughout the end of September and the beginning of October. More to come on this, more rate cuts expected between now and year end. What does that mean for average auto loan rates? Stay tuned for future episodes so you can stay in the loop.
The reason why rate cuts would happen and actual interest rates would go up is
We are in the 3-year, 5-year, 7-year sector of the curve, not the 1-month sector of the curve, which is what the Fed controls. And sometimes the market doesn't like lower rates farther out the curve. And that's just what we've seen. So this is an interesting indicator. We're in orange here. This is cars and light trucks, but alongside moving cars here in the US is moving heavy trucks. It's a much smaller market. Auto dealers are 9% of retail sales in the US. Heavy truck dealers are are probably a fraction of that, but these are 16,000-pound trucks and they tend to move in the same cycle. We're watching this coincident indicator that doesn't necessarily lead or doesn't necessarily lag, but it's kind of alongside the auto market, and it's been weak for the last 24 months. So it's just something that we're monitoring here. It is most likely an input into pickup truck sales. That's the most adjacent part of the market to heavy trucks. So before we scare ourselves too much this pending Halloween and declare the used car market dead before it actually dies, let's keep in mind that about 15% of, if you measure this according to Cox, of used car sales are subprime. And also, there are other ways to look at this as well. This is a murky part of the lending space. Many dealers don't even have a subprime relationship. And also, a lot of used car deals are done in cash. So there are a lot of arguments for that 15% number to be smaller. And just let's keep in mind, we're talking about a small corner of the world when it comes to unit sales that are coming, but the numbers that are in that corner of the world are pretty ugly. So this graph that we're talking about here is very familiar to you, the Market Minute viewer. We've shown it many times over the last few years. The red stuff is subprime, and right now we're seeing 5+% 60-day delinquencies, and that's at all-time highs. But if you look at the prime borrower, which is most of the market, which by the way also echoes the new car buyer, we're at only 40 basis points, and that's a pretty standard level of delinquency. But in the subprime space, the data is ugly. Let's take a look. Let's open the door of the haunted house here. Why? What the heck's going on? Well, let's take a look at this graph on the right. And that is for the last 4 years, underwriting in used cars has not been working. So a functioning used car market is what all of these curves in the lower right look like. They all converge around over, 7 years, about 9% of some form of delinquency. Now that could cure itself, right? Come in with a check and fix the fact that he's fallen behind. These aren't necessarily defaults. These are just loans that just fall into 90-day delinquency. And so for years, it looked very harmonious and it looked like this set of lines on the lower right. But look at the last 3 years. This is 22, 23, and 24. And what we are starting to see, the last 4 of these curves are elevated. And so the market has got to figure out how to re-underwrite these, whether it's LTV, whether it's new income requirements, or whether it's just saying no to a degree. And that's why we've seen the blow up that we have seen at Tricolor is the market has finally just given up and said, look, the loans that are coming out of these companies that package and assemble these for securities isn't working. And so that's got to be fixed. And that's why we saw the Tricolor situation. So this is the purple line here. This is kind of what Tricolor represents. This is the LTV here. So a customer is coming in underwater on used car number 1. They're taking that air ball and they're rolling that into a loan on used car number 2. Maybe they're throwing in some cash, maybe they aren't. But these LTVs, which as recently as 4 years ago, were around a rather rational 104%, have blown out to 130 and 140%. And those are going to get retightened. So expect these lines to converge and expect maybe even the bank line to fall a little bit. But these other actors in the market, these lines are going to come back down. It'll probably take about a year to readjust this market to lower LTVs.
And expect my rant at the end to reflect this in many ways.
Whether you're having a good time at the party, sometimes it's what are the other guests doing and who else is at the party. And right now, we have a bunch of young kids at the party that are ruining it. These are the student loan borrowers. And unfortunately, we turned off their student loans because of COVID, and we just turned them back on again. And it is causing a lot of pain in the student loan category itself. It's causing some pain in the credit card category. And so we are seeing some consumer weakness. We are worried a little bit about credit card delinquencies and student loan delinquencies. It's pulled up auto delinquencies a little bit, but the really scary chart is the next one. This is how many consumers are going 90 plus days delinquent on their federal student loans. Well, we can make assumptions about these consumers. One, we can assume they're here in the US because they are. And 2, we can assume that they are potential car buyers because, well, they are. Actually, 47% of them have an auto loan alongside this. This graph is over 6 months, 5 million consumers, 5 million student loan borrowers, half of which have an auto loan, have gone delinquent on their student loans. Luckily, usually the car loan is the last thing people go delinquent on. It's unpleasant to walk to work, and it certainly will be in November. This is just a very interesting stat. These are consumers that are going to slip from prime into subprime. So that bigger market is going to expand where there's going to be less capacity. And this is probably going to take a year or two to sort out. And so unfortunately, these are some younger consumers that may be shut out of the car market for a couple of months until they get their affairs back in order.
What the hell did we expect? A couple of things here that I want to focus on. And first and foremost, it's fiscal responsibility to ensure that we, as Americans, can be able to live the life that we would like to live. And so a couple of things here that are very, very important. First of all, wages are up over the last 5 years, approximately 23%. Vehicles are up 30%. Food is up 28.3%. Interest rates are up 250 basis points. Home insurance, 35% increase. Car insurance, 52.5% increase. So what do we choose to do? Let's lengthen the car loans. Let's lengthen it. Let's mortgage our future. I want to sell more cars than anybody, but I also would like to make sure we're not mortgaging our future. I enjoy every single month learning from James, who has a tremendous amount of experience in economics. I learn a tremendous amount from Phil. I come in as the guy that runs small businesses. I've got Fountain Forward. I've got Accounting Labs, our accounting business. We're selling, luxury watches to the rich people. We've got assisted living places. We got rentals. We got some commercial real estate, retail, etc. It's like I get to see all that, and I mostly stay out of macroeconomics, and I learn from these guys. And what I see is I see the fact that, again, wages are up 23%, but everything got more expensive. And you might be saying to yourself, well, Stephen, we already know this. Okay, look what we got ourselves into. This isn't shocking. Nobody should be surprised. And at no point, we shouldn't expect to James talking about the fact that it's going to take a while for the 3 and 5 year loans to reflect these changes, these rate cuts. We shouldn't expect for anything to turn around. We should expect for more pain to be incurred because it's our fault. And I think what's cool is we'll be very resilient. And I think the jobs overall will stay very strong, according to what I've learned from you guys and what I've read. But I think it's important to, again, look at the statistics and realize the fact that everything got more expensive. And so what we decided to do is we decided to just pay for everything and then extend our loans. And it's like, well, why don't we cut some of the bullshit we don't need, and then we can get the car that we'd like, and we can get it the right way. Because realistically, dealers want to do the right loans as well, so they don't get chargebacks. So no, I'm not anti-selling more cars. I'm pro-selling more cars, but I'm pro-selling more cars the right way because we're not spending our money in a ridiculous way just to be able to go get that damn coffee or to be able to go and eat out. Try eating at your house. Try not getting that coffee. Buy yourself an espresso machine and make sure that you can afford the car, getting the right loan. And I think to James's point, I think the banks are going to figure out how to do the right loans. And I think that's going to put the consumer, the American consumer, in a much better position to be prosperous going forward versus continuing to mortgage our future. I want the best for everybody. And I think it's just stupid when we just all of a sudden forget about our future. And I think that there's a lot of great things that can be done, but my God, the numbers don't look real good if we just keep spending everything. On behalf of my esteemed colleagues, Mr. James Sivko and Phil Chebotowski, my name is Stephen Georgella. This is the Automotive Market Minute. There's many more to come. We'll see you next month. Out.